Good afternoon, everyone. Thank you for joining today. I'm going to give everyone one more minute to get in. I hope everyone's afternoon is going well. Okay, welcome to Surety Bonding 101. Today's date is November 7th, 2024. We have a wonderful speaker here for you today, so please make sure that you're paying attention, and let's get started. Just to review some participation requirements, if you have a question, please use the raise your hand feature to be acknowledged or the chat to ask your question. Cameras must be on during the webinar period. Please keep your microphone on mute unless you're speaking. And please participate. Be an active participant for this session. And if you're able to, change your name and company name. I know you guys have received some phone calls encouraging you to participate in today's session, but we have a wonderful and informative speaker here today who's willing to respond to any inquiries that you have. So please take advantage of that. To go over our presenter, his name is Matt Foster. He is the Vice President of the Surety Department at Interwest Insurance Services. He has 20 years in the property, casualty, and surety industry. He is a commercial and contract surety solutions expert and a general liability and workers' compensation specialist. Now we're going to get started with the presentation.
Hi, everyone. My name is Matt Foster. Happy to be here. I know everybody has, extremely busy schedules, and, I appreciate you guys taking the time out of your schedules to, interact and learn a little bit about contract bonding, what it's all about. Hopefully, what I say today is going to be informative for you guys and maybe opens up some doors for you from a business side of things, and maybe opens up some avenues for you to conduct a little bit more and maybe get into an industry that you're not overly familiar with. But yeah, happy to be here. Just wanted to give you a little bit of background about myself before we get started. I've been in the industry for about 20 years, started right out of college. I worked for a smaller agency here in the Sacramento area. We basically helped out contractors get started. So we helped them out with their licensing with the contractors board, help them get bonding, insurance. Basically, we were with them every step of the way, and work with these contractors to grow their business. And just really enjoyed what I've done, and the clients that I have and the contractors in general. So it's been a fun run, and looking forward to having meeting all of you guys maybe down the road and working with you towards wherever your bonding needs are down the line. So yeah, so I created this little PowerPoint presentation to give you guys just a general understanding of just how contract surety works. It's not everything, but I think it's a great way for you guys to understand how the industry works, what the basics are, and give you just a general understanding. So the next time you're interested in maybe moving forward with bonding, you'll have a little bit more education to where it makes things easier down the road. So I do want to preface this that feel free to ask questions throughout this presentation. I'm here to help and educate. So don't think that this is a lecture. I'm not the teacher here. So by all means, interrupt, ask questions. I'm here to help. there's probably going to be some things and some questions that you guys might have that we don't address right now. No problem. If you go to the next page, my contact information is readily available. Feel free to shoot me an email or give me a call. Happy to answer any of those questions for you guys. You know, even if it doesn't hit you right now, you think of something down, you know, a couple of days later, just give me a call, shoot me an email. Happy to talk to you about whatever questions you have. So we'll go ahead to the next slide. You know, basically, how surety works is, especially contract surety, it's ultimately a three-party agreement. You have the principal, which is you guys, the contractor. You have the general contractor, if you're a sub, or you have the obligee, which in public works cases is usually a city, county, municipality. Whoever's going to be requesting that bond from you, they're referred to as the obligee. And then the third person is the surety company. So this three-party agreement is basically what forms a contract bonding relationship. Go ahead to the next page. So a couple of different types of contract surety bonds. I'm sure you guys have maybe heard of these. The first one is a bid bond. Ultimately just guarantees that a contractor accepts a project with a realistic bid and fulfills their bid obligations. And, you know, assuming they are awarded the contract, the bid basically guarantees that whatever the contractor did bid is a realistic number that they can fulfill to get that job completed. Bid bonds are usually required on an actual project, you know, bid list, and you're going to be bidding against other contractors. And again, that bid bond just guarantees your bid against these other contractors. Performance bond, if you were awarded a project, you're going to usually be required to produce a performance bond, and that ultimately guarantees that you're going to fulfill your work on a given contract, protects the owner for any type of risk of a contractor default. Payment bonds are ultimately just making sure that your subcontractors, your laborers, your suppliers are being paid. It just guarantees that all those parties are basically going to get paid for the term of the contract. You can go to the next page. Majority of states do require performance and payment bonds. They are always, pretty much almost always 100% of the contract price. Bid bonds can vary. They're typically 10%. Sometimes they go down to 5%, but 10% is usually what the amount of the bid bond usually is. You go to the next page. Now, bonds are, you know, they are different from insurance. There's a couple of, you know, big differences between bonds and insurance. Just covering a couple of just minor things in regards to a bond. When the underwriting is conducted on a bond, they're underwriting based on a zero loss basis. So as opposed to insurance, you know, insurance, there's always an assumption of claims. And so they will typically have rates determined on class codes that determines premiums. On a bond, the premium is determined based on the contract amount. Bonds are non-cancelable. Insurance you can cancel. Non-payment results in cancellation on insurance. Non-payment doesn't affect any liability on the bond whatsoever. So that's the main differences between the two. You can go ahead to the next one. Why are bonds required? Right now, they're saying roughly about 29% of contractors fail annually on public works projects. So it's a form of risk mitigation, and it definitely gives some assurances to the construction industry. You provide insurance that you're ultimately going to fulfill your obligations and perform and meet and get the work completed. And it gives the obligee financial security, obviously, to make sure that they're comfortable that a project's going to get done, even if the contractor can't perform the work. So that's ultimately why bonds are typically required. You can go to the next one. Surety is definitely without not without risk. There's mistakes, surprises, things that can happen throughout a project. You know, there's a lot of different things that can go into why there's claims on bonds. We'll dive into that in a couple of slides down, but just you know, it is something that does happen, not often, but there are risks associated with these bonds. You go to the next one.
I actually had a question for you, Matt.
Sure.
Are bonds an insurance product?
I mean, they are considered insurance, but they are very different from insurance. You know, the bond ultimately, with insurance, there's always an assumption that there's going to be claims. With a bond, the assumption with the underwriting that goes involved you know, that's involved with actual underwriting bonds, the assumption is that there's going to be zero claims. So in a sense, it is a form of insurance, but it's not a protection for the contractor. It's ultimately a protection for the people that you do work for. So that's ultimately the difference.
Thank you.
Yeah. So in regards to, you know, how bonds came about, you know, the Miller Act was enacted in 1939 to ultimately guarantee that projects were going to be completed on the federal level. There was concern that, you know, the public was, you know, needed some type of protection from contractors. So the mandate is usually 100,000 on federal projects. You guys will probably see on a lower scale, projects usually above 25,000 will require performance bonds when it comes to public works. Usually any amount after that or under that, they can usually waive that requirement. So just something to know ahead of time. So who are the players on the bonding side of thing? There's you got kind of three different levels of people and contractors that are involved. You got your general contractors, so you got your heavy civil contractors that do dams, bridges, highways, tunnels, you know, really large scale projects. Water, sewer contractors, you got wastewater treatment plants. But, you know, there are general contractors, people that are doing office buildings, major TI work, school work. You know, I know there's probably a couple of GCs in this presentation. You guys would fit under that category, but you have some lower subcategories as well. You have prime subcontractors, electrical and mechanical. And then there's the specialty contractors, the landscaping, the demo, plumbing, all those fit under that kind of specialty fold. So just in terms of public works, bonding is almost a necessity and almost a standard requirement. You are starting to see a little bit more bonding on the private side. Private can be a little bit more difficult because the surety company has a little concern where how the project's being funded, and would also ultimately need to see proof of funding on a private job in order to feel comfortable bonding a private job. So benefits of bonds, I mean, for the owner, for the obligee, obviously, when a contractor is able to bond, it typically means a couple of different things. One, that they're a qualified bidder. They've jumped through hoops that the surety companies have required in order to get bonding. It helps the owner reduce risk of liens because they have a bond in place. It guarantees basically timely project completion and defect protection. So it's a huge it's a huge safety net for these owners to require these bonds. And that's ultimately why that they actually do require them. So, might have some questions in regards to, how you get qualified for bonding. Just this is just a kind of a simple punch list of some items the surety company likes to see. The first one, it says 3 years business financials. That's not entirely accurate. There's certain levels of bonding for contractors, depending on, where you are, in the life of your company. If you're a newer contractor or just kind of on the smaller end looking to grow, business financials are going to be important. Do you need 3 years of them? Probably not. Having a business financials just in general would be a good thing for you to put on your radar. Personal financials, the surety company wants to see not only how your company is doing from a financial standpoint, but they also want to see what your personal side is as well. In the event that your company, might not perform well, you might have some financial issues on the company side. They'd like to feel comfortable that you at least have some assets on the personal side to be able to step in and prevent any type of loss, or regarding a bond payout. Net worth minimums, working capital minimums. We'll get into that a little bit later. But ultimately, having decent assets on hand, not as much debt, those are all good things that can help you build your bond capacity. Acceptable class of business. Yeah, that one's a little bit tricky. Obviously, the surety companies, they don't love to bond certain types of contractors, asbestos contractors, any type of hazardous materials where there's higher risk for potential claims, things like that. That's usually not going to be a huge issue for most people, just because most of you do that type of work. So demonstrated performance track record. It really does help a surety company if you have a little bit of experience. If you have some prior projects that you've completed to fruition, and if you have the ability to show that you have the track record to work on larger projects, those are all really helpful, definitely. And then personal indemnity, like most contracts, you will be signing both on the business side and on the personal side. Same thing goes with the personal financials. They want to make sure that if there was ever a risk of a bond payout, that at least signing on the personal side as well, to help out in the event of the bond payout. By all means, fire away if you have any questions. This is just a standard presentation. I know it's not the most exciting. Sorry I didn't have any magic tricks or anything to liven it up. But by all means, if you guys have questions, fire away. I'm here to help.
So I have a question. I know I shouldn't, but I have a question. So what happens if I don't qualify for the bond and want to bid on a project? What are my recourses? Oh,
That's a good question. That's a good question, Jennifer. So our goal as a bond agent is to always be able to try to find a home for a contractor if they want to get into bonding. Okay. So assuming that they can't qualify for a certain bond company, it doesn't mean it's the end of the road for them. It just means that the agent kind of needs to work a little bit harder to try to find a home for them and work with different bond companies out there that might have some solutions for the contractor. There's a lot of bond companies that want to help you out, and they have some special programs in place. The SBA program, Small Business Association, there's some fantastic, availability there where, contractors that may not have the best credit, they may not have the best financials, there's still options for them to qualify for bonding, and be able to stay in that field without having any options. So yeah, there's typically options for every contractor out there.
I also wanted to, Kisu, if you want to take yourself off mute and ask a question.
Okay, thank you. I'm just curious as to, you mentioned previous contracts fulfilled. What if you are a small subcontractor and you don't really have any substantial jobs that you've done already? How does that go?
Yeah, so typically if you don't have a huge project that to show a surety company, they understand that. They understand that contractors have to grow in this industry. So they wouldn't expect someone to say, oh, well, I've done a $400,000 project, I should be able to bond a $400,000 project right out of the gates. Well, I mean, they understand that. So if you don't have the track record, that's okay. You can still get bonding, and maybe we're talking about maybe looking at projects maybe in the $100,000 to $200,000 range to get started, and then you work your way from there. So let's say you got a project that you've done for 20,000. So maybe the first, bonding project you go after is maybe 80 to 100,000. You get that one taken care of. Now you got an $80,000 or $100,000 project under your belt. Now you can start looking for a $150,000, $200,000 project. So it's stepping stones when it comes to bonding. And the really nice thing is that, surety companies, they can give you some flexibility in regards to job size if you're looking to get started, things like that. So yeah, don't fret if you don't have, extreme job experience or, the like high level, high dollar amount project experience. That's not going to prohibit you from being able to bond. So, there's options for you guys out there. So, and we'll find them for you. So hopefully that answers your question.
It does. Thank you very much.
You got it. You got it. So, just talking about surety company checklists when they do some underwriting. Yeah, I put Honest Abe out there. I mean, ideally, they're looking at a couple of different things. Good character. They do ask questions in the initial underwriting process if there's been any issues in regards to construction defaults, bond claims previously, things like that. So they're looking for good character individuals, experience matching contract requirements. So kind of what Kisa was talking about. If you got a couple of smaller projects under your belt, then obviously they're going to match contract requirements to your experience. Financial strength, also important. That's something that that grows with your business. Credit history. Credit does come into play. This surety relationship is credit based. If you guys have good credit, that's a great foot in the door to getting a good bond program started. Even if you don't have the best credit, there's still options out there, but having good credit is very helpful. I will say that. So, banking relationship, that's, typically referring to if you guys have maybe expressed some interest in starting like a line of credit with a bank. That's kind of what they're referring to. Bond companies do like seeing having a bank line on hand just to help you out in regards to expenses throughout the year. If you need to tap into that, it's a good resource to have and a good asset. And then necessary equipment. That's if you're really looking to get into heavy public works projects. At one point, the surety companies would, typically will do a job walk, come to your shop, that kind of thing. So They just want to make sure that you have the necessary equipment to fulfill a project and a contract. So move on to the next one.
I have a quick question.
Yes, sir.
When you speak of credit, is that the business credit or your personal credit?
Personal credit. Personal credit. Yeah, they will do a credit check on all owners of the company. So because when you get a bond in place, you're typically indemnifying both on the personal side and on the business side. So they do check personal credit when they do their underwriting. Did that answer your question?
Yes, I'm sorry. Thank you.
Okay. Oh yeah, no problem at all.
So is that a hard pull, and if so, at what point does that happen?
It's
a good
soft
question.
pull.
It's a good question. It's by law, it's an insurance underwriting credit check. So by law, it can't affect your score. And in fact, it doesn't even show up on your credit report. So I know people get a little bit concerned with that, but it is a necessary requirement for insurance. And so especially on the bonding side. And so no, it does not affect your score. Yeah, I've been asked that question a number of times. People get a little squirrely about it, but it does not affect you. Sorry. Screen went dead here. Did somebody have a question? I'm sorry. I think I saw one pop up. How does that work for an ESOP? Well, I suppose it depends on the ownership structure of the company. But typically the underwriting is going to be done on anybody that has typically about 10% or more of ownership in the company. I don't know if that answers your question or not. All right, so just some basic, kind of financial definitions for you guys, and just some general understanding. You'll be hearing these types of phrases, especially when you get into the bonding side of things, and the underwriter is going to request certain things throughout the year. But working capital, it's just the difference between what your current assets are and what your current liabilities are. So cash, accounts receivable, inventory, materials, things like that. Those are all considered assets. Liabilities are just, payables, debts, things like that. So having strong working capital is always going to help you build your bond program and build a higher capacity for you. Financial statements. So this is kind of a big one. Financial statements are going to be important to get a really good, solid bond program going for your company. There's a kind of different levels of financial statements that you can secure. If you're starting out, realistically, it's going to be good practice for you to have some type of accounting software that will be able to generate financial statements for you on a pretty much a semi-annual basis. QuickBooks, I know, is a good one. Their software is great, and can generate a balance sheet, profit and loss statement. You can typically generate an accounts receivable and accounts payable report. Those financial statements are crucial because it gives the surety company a pretty strong understanding of how you guys are doing as a company, and how the year is going. If you're being profitable, if you're not being profitable, all those things are really helpful. And so there's some contractors I know that that unfortunately don't have aren't able to provide proper financial statements, and it definitely hurts them from being able to grow their bonding. So it's just something to keep in mind. If contract bonding is an industry and an avenue that you'd like to pursue, financial statements are going to be important. What typically once you get over the $1 million mark on a project size, that is when you're going to see surety companies start asking for CPA financials. So if you're looking to ultimately secure larger projects in the excess of $1 million, $2 million, things like that, getting a CPA involved in your financials are going to be really helpful. Again, we can go into extreme detail in regards to how to get that going and what the process is. I can answer questions for you guys anytime, but this is obviously just a presentation to kind of get you guys a little educated in regards to the bonding side of things. So but yeah, that's ultimately financial statements, one of the key things to growing your bonding capacity. And then work in progress report. If you can go online, and there's plenty of templates out there, but work in progress reports are really helpful for a surety company. It ultimately gives the bond company an idea of what projects you have on hand right now, what the progress is on those projects, what's the cost to complete, what are you looking at for profit, are you overbilling, are you underbilling? All these things can be really helpful to a surety company to say, hey, these guys are on track on these projects, everything's looking good. Let's this allows us to expand their bonding capacity even a little bit more. So those are the three kind of big key terms to know from a financial standpoint. So just keep those all in mind. Contract failures, it definitely happens. The pre-qualification process does reduce the likelihood of a claim, but things do happen for sometimes unforeseen reasons. You can go ahead to the next one. Just to kind of give you some ideas of what could happen or what could cause failure on a potential bonding contract. Couple of things. Overexpansion. That's just referring to you just have too many projects on hand. You're spreading yourself too thin to where projects aren't getting completed in a timely manner. You just can't get things done on time. Those things can cause problems. Poor accounting, financial controls, just not keeping track of where your money's flowing. Those things can certainly cause problems. Uncontrollable factors. I mean, it's unfortunate, but I mean, I've had some colleagues that have had some really wild situations. A contractor was about 30% of the way through a contract, and was on a plane with a couple of his key members, and plane went down. And he ultimately lost his life along with his other members, and his wife had to ultimately try to take over the business. Unforeseen factor. Those types of things happen. It's super unfortunate, but those things can happen from time to time. Subcontractor failure. Really do your due diligence when you have subcontractors working for you, making sure that they're performing their portion of the work. Very important. Owner failure. I mean, that's just simply means that, if you're the owner of the company, stay involved. Making sure that your key personnel are doing what they need to be doing, and always trying to stay on the ball with every contract you have. Onerous contract terms. When you get into contract bonding, is going to be crucial for you to really keep an eye out on your contracts. Make sure the wording on those contracts are contractor friendly. look at the termination clauses, things like that, that can, that can really pinch you if there's some issues that pop up on the project. Change in scope of work, those things tend to happen. Soil erosion, things like that, where unforeseen type situations that causes changes in the scope of work, making sure that you've bid enough to where you're able to compensate in the event that there are changes in scope. Go to the next one. Items to look for in contract. We talked a little bit about that. Termination clause, that's something to keep an eye out for. But the two big things in a contract that the surety company is always going to want to know, especially on even on a bid request, they'll want to find out what the liquidated damages are on that project. Liquidated damages are pretty much a set amount that they will charge you for any day you go beyond the anticipated end date of a project. So keep an eye out for that. Liquidated damages typically are anywhere from $200 a day. They can go up to $2,500 a day. And then warranty period. That's basically a time frame that they set where a contractor will ultimately repair faulty work on the project scope. Most carriers, surety companies, are willing to do 2-year warranties. If you go beyond that, that typically makes things a little bit more complicated. They'll require, financials from you guys, or there'll be some extra conditions set forth if it goes beyond that 2-year warranty. You can go to the next one. And contracts, they can change. So, and if there are changes that happen, this is a big one, and I try to really hammer this into my clients. But when changes happen, you have to notify your bond agent as soon as possible to let them know, so we can make sure that the surety company is aware of any types of changes on a particular contract. You can go to the next one. The reason I say that, just kind of bringing up an example here. This is basically a surety company versus a construction company. Principal failed to notify the surety company of a change in increasing price. And so ultimately the surety company was found not liable for amounts over that contract price. So if there was a claim that happened and you didn't notify the surety company, let's say a project jumps from 700,000 to 1.4, and you don't alert the surety company and there's a bond payout, surety company's not going to support that full 1.4. They're going to only support the original contract price that they bonded for. So just give you an example of just having open communication with your bond agent. That's always the way to go. And alerting the surety company if there are any changes. Go to the next one. All right, so I know you guys have some questions in regards to, what is all this going to cost from a bonding standpoint? So bid bonds, if you have a good agent, there should be zero cost to you for bid bonds. Because bid bonds, ultimately, they don't guarantee that you're going to secure a project. I mean, bid bonds are really there to help you bid a project, and hopefully you win it. But yeah, no cost for a bid bond. The only time you're ever going to be required to pay for a bond would be if you win a project and are required to produce performance and payment bonds. And we'll get into the performance bonds right now on the next slide here. So performance bonds, typical price range on a performance bond, it does vary. So you have, beginner programs, kind of the credit-based programs that can typically bond you all the way up to $1 million, just sometimes based on credit and experience. Rates for those types of programs can usually range about, it says 0.5 to 4%. It's usually 3%. So 3% is what you're going to be looking at. That's on the max amount from a premium standpoint on a bond. Once you kind of get your foot in the door with some bonds, there's always opportunities to get those bond rates reduced. But 3% is typically a rate that you're going to be looking at for a bond. Just to kind of give you, a rough idea, $300,000 project, for, let's just say $400,000 project times 3%, you're looking at, about 12,000 for the bond. So
Now, how do we get the bond costs reimbursed?
that's a good question. That's a great question. There's not, when you pay for the bond, you're ultimately paying for the opportunity for the bond company to produce that bond instead of posting full cash for a particular project. So that is a premium that you pay. There's no refunds on that bond. So it's not, is not a refundable deal. That's just the premium that you pay for the bond company to post that bond on your behalf.
So we should include it in our bids.
Absolutely. Great question, Jennifer. When you're getting your bids prepared, it is important to include cost of your bond. And then, you may want to check with your insurance agent as well, just to make sure there's not any extra charges or requirements that might increase your insurance premiums. So absolutely factor those costs in when you're looking at pursuing a potential bid. Great question. Thanks, Jennifer.
Sure.
And that payment is due before the bond is issued. That's not like a pay at the end or pay in the middle, or that's due up front.
No, it's a good question, Kisu. So typically it depends on the agent that you work with. Our agency is super flexible. We don't require payment up front to get that bond issued, just because we know, obviously you're not sometimes getting funds right away from that obligee. So, typically we'll give you, 90 days, usually to get, to have payment done, which, usually if you can get that in your first draw, on a project, that's always helpful. We sometimes go beyond the 90 days as well. So, I mean, we work with our clients. We understand that sometimes funds are needed to get a project mobilized. So, we don't require that right on the get-go to get that bond issued.
Okay, thank you.
You got it. And I do have this little note right here about, there are some additional costs. If it turns into an SBA type situation, there are sometimes additional costs that the SBA charges in order to be in their program. But for the most part, 3% is typically what you're going to be looking at from a premium standpoint. I would say 2 to 3% is pretty much the standard. So, yeah, in conclusion, ultimately what surety kind of boils down to, it's informed decisions on risk management. It's, the surety company having a solid understanding of their contractor, feeling comfortable to issue a bond that ultimately guarantees a contractor's performance on a particular project. So, it is a great form of risk management for the obligees, and that's why they require it. If hopefully, what I've said today has been helpful, and just really appreciate the opportunity that Merriwether Williams, just for having some contractors get together to hear a little bit about how the contract bonding industry works. So, by all means, any questions, happy to answer them right now. And then my next slide right here, I have my contact information. So feel free if you guys want to take a screenshot or anything like that. If there's any additional questions you might have, I'm always available via email or by phone. So don't hesitate to reach out. I'm here to help you guys.
Thanks for this, Matt. This was very informative and very useful information. Appreciate it, buddy.
You're welcome. My pleasure. My pleasure.
And I'm going to give a short presentation. Matt, I'm hoping you stay in case people have questions as well.
Sure thing.
And I'll be talking about how we work with you together.
There we go.
Key, so you be careful driving. I'm just going to say it because it's just how I roll. You know that.
Hey, us growing small businesses, we do everything all at one time.
I know you do. I know you do.
Thank you. I will.
Okay. And Johanna, if you could show your face for the short period. My name is Jennifer Elmore, and Johanna and I are with the Alameda County Technical Assistance Program. And one of the things is that the program has some services to offer, and we work with our program partners. And Matt Foster and Interwest is one of our program partners. We ourselves do not place bonds, but we work with you. So as Matt was saying, they don't earn anything on the bid bond. So one of the ways we can help is we can help you put your package together and kind of make sure it looks as the best possible before we hand it over to Matt, if that is your choice, or we work with your current broker. So what does the Contractor Technical Assistance Program do? We assist the SLEBs or small and local contractors. We help by identifying contract opportunities. You'll receive emails from us, from County of Alameda. We provide technical assistance. Now, what is that technical assistance? It provides certification assistance. Some of you have been on emails and Zoom meetings with me and Microsoft Teams meetings to go over certification. We do one-on-one training. We do workshops like this and seminars. Some of our one-on-one training is that we will refer you to other sources for help. We have on our team people that can help with training for estimating. We don't estimate for people, but we do training. We start off with Johanna and I giving you an assessment interview, find out what you need for your business, and then we put together resources to help you move to the next level. One of the most exciting things we're excited about is that the County of Alameda offers bonding assistance. And what that means is that, and Matt is aware of the program, and when it's a County of Alameda project and you're a County of Alameda SLEB contractor, we can put up funds up to 40% of the bond amount, or up to 750, whichever is less, on your behalf for the surety to hold. This is a way to get you started with your first bond or entice you to get a larger bond. One of the things that's not listed here, and all of these is whether you're a prime or a subcontractor. So as long as the original contract goes to the County of Alameda, we can put up the letter of credit or the bonding assistance on your behalf. We haven't listed it here because we're refining it at this moment, but the County of Alameda has started the Contractor Capital Solutions Program. So for County of Alameda projects, we have a working capital project specific funding that's available up to $250,000 at reasonable market interest rate. And that should be coming in shortly. It will allow you on County of Alameda projects, and it is not based on the standard underwriting of banks. It is based on how your estimate is, and there'll be an estimate review, and we'll train you how to do a cash flow projection to see when you break even on that project, because we know the County of Alameda, like any other municipality, is a 90-day pay. So the county and Merriwether and Williams want to bridge that gap between the two. Okay, we also work with primes and to make sure they meet their SLEB or ECOP requirements on County of Alameda projects. CTAP is sponsored by the General Services Agency, and to be eligible for CTAP, you must be certified with the County of Alameda. You can see below our contact information is there with emails, or you will receive an email with us with our information after this presentation, with our contact information as well as a copy. The other thing we're hoping is that you can help us do better. Next slide, please. Here's our contact information, and we're going to send out a survey to make sure that we're giving you the right kind of seminars that you'd like to see. Also the times that you'd like to see it. If you could take a screenshot of that.
I'm just gonna quickly put the link in the chat.
Okay. Okay, and there'll be a link in the chat, and if you have any questions, I'd be happy to answer any, since I did talk faster than usual, just because public speaking is not my favorite.
Please fill out the survey. It gives us valuable feedback on how our program is doing and how our trainings are.
Being that that's an Alameda County program, do your San Francisco LBEs, do we qualify for that? Is that something that we can take part in?
So you can take part in the City and County San Francisco Surety Bond program, which is
Okay.
modeled after this. I just,
Okay.
when we spoke earlier, I just wanted to make sure you got the Bonding 101 presentation. I think it's important to know and to plan to make sure that you're building towards it. One of the things that we do is that we work with you until you can become bonded. It's a slow process, and we're willing to, because all of our services are at no cost. They're sponsored by the County of Alameda or the City and County of San Francisco. We will work with you until you can get your bonding or other technical assistance as needed.
Fantastic. Fantastic. Thank you very much.
You're welcome. And please fill out the survey so we know how to improve, what you would like to hear, a seminar that you may not have had that you really think is missing. And then also, if you would like to comment on the times, when it would be a better time for you, so that it fits within your schedule. Thank you, Rena. I'm going to hand it back to you.
Thank you. I think Jennifer covered most of it, but I want to say thank you to Matt for coming today and taking time out of his day to come present to us. I want to say thank you to Jennifer and Johanna for being resources to the contractors and for giving that wonderful overview of CTAP and how it can benefit you as a contractor. We hope to see you at our next joint session as well. You should be receiving an email about that shortly if you're signed up in our mailing list. We're going to cover financial information, business information, so you can prepare for tax season.
There we go.
Yay, tax season. Woohoo.
Kisu, we will include you on that seminar.
Please do. Please, I want to be included on any and everything.
We'll be
Thank you.
included on every single seminar moving forward.
Thank you very much. I appreciate it.
You're welcome.
I'm filling out the survey right now.
Thank you. Just not while you're driving, please.
No, not really right now, but yeah. Exactly.
I get it.
Gotcha.
And all this information, as Jennifer reiterated, will be sent to you after the session is over, or should be sent out either Friday or Monday. You'll receive it.
Give us a week. Let's over promise and under deliver, or vice versa.
Vice versa. There you go.
Once you're done with the survey, feel free to head out.
Thanks again, everyone.
Thank you,
Appreciate
Matt. We
guys.
really appreciate this. You've
Thank you,
given
Matt.
a lot of information that's really important to our contractors.
Right.
Well, good. I'm glad it was helpful. And by all means, feel free to reach out if you guys have additional questions. Always here to answer them. My goal is to help you guys grow your bonding business and see you guys improve. So that's the #1 goal here. So whatever I can do to make that happen, let me know.
Will do.
Thank you, Matt.
All right. Thanks, everyone.
Thanks, Jen. Thanks, Johanna.
Thanks,
And
guys.
I guess your name is Kim?
Rena.
Rena. Thank you, Rena. And Jen, you already know, do you
I'll
know
see
that
you
new
tomorrow
me?
morning at 10:30, sir.
Yes, ma'am.
Bye.
Thank you, guys.
All right. Take care.
All right.
I'll hang out here for one more minute and then I'm gonna close the room. If you guys have any additional questions, please make sure to ask while Matt is here and while Jennifer and Johanna is here. That's everyone. Bye.
I think that's it. All right. Thanks. Appreciate it.
No.